whether I am recording this session. Oh my, no. So I can start all over again. For the sake of those people who come in late and those who want to access this later. Now, I have said several things that the accounting cycle is a process that consists of procedures that are used to collect, process, and report economic activities of a business within an accounting period, And then I have said that the accounting process will consist of three major parts. One is the recording of transactions during the accounting period, which means if, for example, our accounting period is January to December 31st, it means all through each and every day throughout the year, we will be recording the financial transactions. We will be recording them throughout that period. Then number two, we have said that it is the summarizing of the information at the end of the period. And probably that what would mean is that those items that are the same will be summarized together. So that if January 1st we sold our product and got 1,000. January or February we sold and got another 1,000. March we sold, got another 1,000. Then at the end of the year, we need to summarize them and say, for example, the sales that we have made, we have sold 11 or 12 items, each at 1,000. That will be 12,000 in that year. That will be summarizing, right? And then number three, the other major part, number three, is the preparation of financial statements. Once we are able to know all these items in terms of sales, in terms of stock, in terms of purchases, then we should be able to prepare the financial statements. We should be able to prepare the financial statement. What do you mean you can't hear? There are people who can't hear what I'm saying. Is it for all of us? No, yes, no, yes, no, yes. So probably you look at you look at your net first before you complain. If there are other people who are hearing now, I can only assume that I'm okay from this side. Thank you. So you look at your net first, eh? You look at your net first. Look at your net first before you can tell us to sort you out. Good. Now, I've said those three parts must always be there. Those three parts must always be there. And that is the process of accounting. Now, the accounting cycle is a complete sequence of accounting procedures which are repeated in the same order during the account period. And therefore, these are repetitive things. They are repetitive things. Today you record transactions, tomorrow you record them, the other day you'll be recording them throughout the year. Now, there are several steps that involve what we call accounting cycle. There are major steps that are involved as far as accounting cycle is concerned. There are several steps that are involved as far as accounting cycle is concerned. Number one is that transaction occur and information is collected through the use of source documents. The information, maybe in this, I can try and see whether I will share this. Let me see where we are. Good. Maybe I can share this so that you see what is here. Share the screen. I am not sure whether you're seeing it now. right? Not sure whether you're seeing it now. And therefore, we are saying that these are the major steps in the accounting cycle. These are major steps in the accounting cycle. What is it, William? What is William saying? Because now when you start raising your hands, you are interrupting. There's nothing that you're saying. You don't try things here. If you raise your hand, I'm able to see that you're raising your hand from this side, right? I'm able to see that. Yeah, good. It is visible. Thank you. Now, I'm saying that these are the major steps in accounting cycle. People are still getting in at this time. These are major steps in accounting cycle. One, transaction occur and information is collected. Transaction occur and the information is collected through the use of what we call source documents, right? And number two is that the transactions are analyzed on the basis of the source document and they are recorded in a journal. That process is called journalizing. We'll be looking at it later. We'll be creating journals later. Number three step is the information is transferred and posted from the journal to the ledger accounts through a process that is called posting. Through a process that is called posting. Number three is that number three or number four? Number four is that a trial balance is prepared from the account balances in the ledger. Once you are able to prepare the ledger or to post the information in the ledger, then you need to extract what you call a trial balance, right? After extracting a trial balance, then you will need to do some adjustment, right? And correct and update the data, especially in case there are errors. And then after that, you prepare the adjusted trial balance, right? And you summarize that data in the form of a financial statement. From there, then you can close the accounting records to summarize the operation of a period. When that period comes to an end, you close the books, right? You close off those accounts and indicate the balances. From there, then you are able to prepare the post-closing trial balance. Once that is prepared, then you can prepare financial statements. You can prepare the financial statements. Now, you don't have to worry about all these steps. You don't need to worry about all these steps. We'll be doing it practically. We'll be doing it practically. And therefore, I expect that you'll be able to follow. We can't hear a thing. Unless you've muted yourself. What have you done with your mic? You've been given direction here. Can you try that? From the bottom left, click audio, then click call via internet for you to hear. So can you do that? Can you do that? Otherwise, we lose you in our explanation here and you'll not get anything. So I hope that is clear. I hope that is clear. We'll be seeing this as we move along. We'll be seeing these things as we move along. So allow me to remove that sharing. Allow me to remove that sharing from there. Who are still getting into the class? These are people who come late. Tina, Tibe, and Kevo. Where are you from? So we proceed. Now, I want us to look at the forms of information, form of information, so that we see some of the books where that will be interacting with, some of the books that will be interacting with. One, we have the books that we call source documents. We have books that we call source documents. We have books that we call source documents. Now, source documents are the physical basis upon which business transactions are recorded. These are the physical basis upon which business transactions are recorded. Some of them will be retained and must be retained in the business as an evidence, because when the auditors come, they will be looking at them, right? They'll be looking at them. And some of these documents that we're talking about here as a source document will include, one, we have checkbook summaries, we have invoices, it may be sales invoice, purchases invoice, we have pay-in slips. You know, when you go to the bank, you fill in a form before you deposit money. Such a document is a source document because that information that is there is the one that the accountant will use when they are entering that data into the system or when they are recording that data in the system. So some of those receipts that you receive, the invoices that you get, you know, the bills that you get, those are what we call the source document. Many a times it will show the transaction date, you know, it will show the amount, it can show the name, sometimes a reference number, sometimes it may be a description of that transaction, right? For example, you come to my shop, you want to buy a bulb, right? And you want a receipt. I'll write a receipt for you, right? I give you your copy and I will be left with a copy. Now, that copy that I'll be left with is what I'm calling what? A source document, because it is a source of information. No, let us not talk about the screen. Can you listen? Can you listen? Can you listen? That is what we call a source document, right? That is what we call a source document. We have said they are physical basis upon which business transactions are recorded. Good. From there, we have what we call books of original entry. We have what we call books of original entry. We have what we call books of original entry. And the books of original entry refers to the accounting journals in which business transactions are initially recorded. They refer to the accounting journals in which business transactions are initially recorded. Let me put this here for you so that you're able to follow. Let me put this one here for you. And for those people who are telling me to share the screen, no. I said that's not the way I operate. And I know why I don't operate. This is accounting. This is accounting. These are not notes. This is accounting. You concentrate so much on them when it comes to calculation, it will be an issue. So listen, 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 listen. You listen. So we are talking about books of original entries. Books of original entries. And we have said that books of original entry refers to the accounting journals in which business transactions are initially recorded. That is, once you get those receipts, you must be able to record them in a book, right? At the end of the day, you must record them in a book. Now, that book is what we are calling a book of original entries, because that is where business transactions are initially recorded. Of course, the information then that is in those books will then be summarized later, be it weekly, be it monthly, and posted in a general ledger from which financial statements are produced. Now, examples of books of original entry. One, we have cash book. Two, we have general journal. Three, we have day books. Again, let me put this here. It's important that we are able to capture a few things. Remember, you're not writing notes. Don't write notes. Capture a few things that are a must for you to be able to look at, right? We have cash book, we have days book, and the days book may be sales return, purchases, and the purchases return, right? And then we have petty cash book, we have general journal. Those are some of the examples of books of original entries. Then the other important thing again for us to understand, is that we have what we call ledger accounts. We have ledger accounts, and we'll be seeing this later. We'll be talking about ledgers later. But for the sake of record, we have different types of ledger accounts. We have personal accounts. We have real accounts. We have impersonal accounts. We have nominal accounts. Those are some of the types. Some of the types of ledger accounts that we'll be saying, looking at in the future. Let me see this. We're still communicating here. Good. We proceed. Now, we also have what we call financial statements, because at the end of the day, an accountant is supposed to prepare what we call financial statement. At the end of the day, your work, even when you are recording the transactions, at the end of the day, you are supposed to come up with what we call financial statements. And financial statements are just a summary. They are just a summary of different accounts that are different transactions that have happened over the years. And we have several financial statements that you'll be preparing. One, we have what we call manufacturing accounts. And this is for those companies that engage in manufacturing. Those companies that are engaged in manufacturing of products, they are what we call manufacturing accounts. I hope you get that. The companies that are involved in manufacturing of products must have a manufacturing account. For example, those companies that make laptops, phones, they must have what we call a manufacturing account. Now, from there, we also have what we call trading profit and loss account. Trading profit and loss account. And this is an account that will tell us whether you made a loss or a profit. Manufacturing account will give us the cost of the item that you are producing, right? So that if it is a laptop, it will tell us now a laptop will cost 60,000, right? Or 100,000. If it's a phone, this one cost 5,000, another one cost 20, another one 50, right? That will be shown by the manufacturing account. Now, I've seen that now on the other side, the trading profit and loss account will show us the performance, whether you made a loss or you made a profit in that business, right? From there, we have another account that we prepare at the end of the year, or at the end of the accounting period, that we call a balance sheet. Balance sheet. A balance sheet. And a balance sheet, as the name is indicating, is an account that shows the amount of balances in terms of assets that we have, right? At the end of the year, we need to look at our operation and know how many vehicles do we have? At what value? How many vehicles and at what value? And then we record, for example, say we have 10 vehicles valued at 30 million, right? So all those assets and liabilities will be recorded in a balance sheet. We'll be looking at them in details later. Then we also have another document that we'll not prepare here. We'll be prepared later, which we call cash flow statement, which we call cash flow statement. We have that other document that we call cash flow statement, and it will show us, the net effect of your operation. It will show the net effect of your operation. It will be a summary of the way cash has moved in and out of the business, right? A summary of the way cash has moved in and out of the business. And then we can also have what we call statement of retained earnings. We can also have what we call statement of changes in equity, right? You can call it statement of changes in equity or statement of retained earnings. Statement of retained earnings. Those are the statements those are the documents that we'll be dealing with here and in the future. Now, you allow me, instead of starting off with journals, because we start off with journals, then we prepare ledgers. But instead of starting off with journals, I would like to start with ledgers. Instead of starting with journals, I would like us to start with ledgers. So you write a subheading there, ledger. We start with the ledgers. How do we define ledgers? We can call it a book or a computer file, right? For recording economic transactions. You can call it a book or a computer file for recording what? Economic transactions. For recording the economic transactions. Justin is agreeing with me, ledgers first. Probably he knows why he's saying that. I thought to me it is an easier way. It's an easier way of doing this. We have said that a ledger is a book. Yes, it's a book containing accounts in which the classified and summarized information from journal is posted. There are so many definitions that you can give, right? For example, we can see it is a book, right? A book containing accounts in which the classified and summarized information from the journal is posted either as debit or as credit. Either as debit or credit. We'll see that in a moment. We'll be seeing that in a moment. Each transaction recorded result in an increase or a decrease in one or more assets. I can put it this way. That each transaction that is recorded in a ledger will result in either an increase or a decrease in one or more assets, liabilities, owner's equity, revenue, or expenses. I will come again. That is there. Lynette, I cannot forget you. I cannot forget you people. Must put it there for those people who need to write, right? Otherwise, you'll get these notes. I'll be sharing these notes. I'll be sharing these notes with you later, so you will get them. And Honorable Sanyo, coming to class late. Honorable. What is honorable about coming to class late? Honorable Sanyo. Karibu sana, mkubwa. Good. We proceed. We proceed. This is a very interesting class. Very interesting class. I like all of you people. All of you. Hata kama hatujaonana. Mutoka. Sawa. All right. We continue. I've posted that there. That each and every transaction is recorded result in an either increase or decrease. Now, an account is a device. Is a device that is used to provide records of increase or decreases in each item that appear in a firm's financial statement. Now, listen to this. Listen to this. That a firm or any business will typically maintain an account for each kind of asset, liability, owner's equity, revenue, or expense item. A firm will always maintain account for each and every what? Each and every, maintain account for each kind. The accounts will be maintained for each and every kind of asset, liability, owner's equity, revenue, and expenses. What that means is that we don't classify assets in one account, right? Because all of them are not the same. And therefore, we must keep, for example, an account for land and buildings, or one for land, another one for buildings. We must keep an account for motor vehicles, right? We must keep an account for what? For computers, for example. We must keep an account for furnitures. We must keep an account for cash. All those items that I've mentioned there are assets, right? All of those items are assets. And therefore, we must be able to split it into the different types of assets or different types of liabilities that we have. or different types of revenues that we have, right? That is important. Good. Now, it is important for us to note that each account has three basic parts. Each account has three basic parts. And one is a title. One, we must give an account a title. Number two, it has what we call the debit. And number three, it has what we call the credit. A title, a debit, and a credit. A title, a debit, and a credit. Those are the three items that must be there in each and every account that we prepare. Let me put it here. I'm sure whether it will appear well. Each account must have three basic parts. That is the title, number two, debit, and number three, the credit. Number three, the credit. Very, 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 very important. Very, very important. Now, we can present information in accounts in two major ways. We can present information in accounting in two major ways. One, we can use what we call T accounts. We can use T accounts, or we can use running balance. We can either use T accounts or we can use running balance. Where are you putting it? Putting what? What are we putting? Emmanuel, you don't understand what you say. I'm not understanding what you are asking. Kindly let your peers talk to you. No, 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 it is not tea ya chai ya kukunywa. Come on. Yes, tea the shape. I will show you in a moment. And I've already tea account or what. I've already put it here. Does it mean some of you are not following what I'm writing and typing there? I've already put it here. Tea account is there. Ya pili tumesema ni running balance. Running balance. And again, they are still there. Are you people able to see what I'm posting there? Because now I'm worried. Confirm that you're able to see what I'm posting. Yes or no? Yes or no? Are you able to see what I'm posting in that the group? No, 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 no. Surely. You're not able to see what I've been posting for the last. No wonder, no wonder, no wonder we no wonder we have issues here. No wonder we have issues here. Let me see. Let me see. Me, I'm able to see what you're posting. Adam, this is not good. This is not good. Let me put this information there. Kindly give me some time. Hey, give me some time. Give me some time. Even no wonder some of you are making a lot of noise. Let me rectify something here. Let me rectify something here. Are you able to see that? Whatever I've posted? Yes or no? Just need one yes. No. Why are people saying no? You must be able to see. Must be able to see. Who is messing up with this? You're able to see that. If you're able to see that, then you can proceed. Can proceed. So I'm saying we have the data can be represented in two basic ledger accounts. It can be presented in two basic ledger accounts, and they are there: T account and running balance. T account and running balance. That's a tell you can't see anything. What is wrong with people? Yes, can't see anything. We are seeing for charts. How do we help you to go to chat? Sharing video is not one of the easiest things. You it's not easy. You need to be told, you need to be directed to chat. It is because you are chatting with your colleagues. Most probably it's because you are chatting with your colleagues. That's why you are not able to see what I'm posting there. Me, I'm seeing every message that you're sending. Can we stop chatting with our colleagues? Nimeona, sasa ndio umeona. Watu wakule carrots. Sawa. I agree. So let us continue. It is and can you stop posting a lot of messages there? Because you post a lot of messages, some of you will find these messages and think we are not posting anything. Let me see. Let me see. Uh-huh. Good. I've made some modification. So that you don't chat with your colleagues. Good. We proceed. We proceed. Let us proceed. You see that you can either put them in that way, right? Either a T account or a running balance account. Now, a T account has three major parts. And in this, I want to indeed share and I'm very sure even this one, there are people who will not see. Let me share. I'm very sure even in this one, some people will not see because they are too busy talking to your colleagues. So I know they will not share. So I'm saying that a T account has three basic elements. One is an account title. It is an account title, and then it has this debit side and it has a credit side. Normally, this debit will be, let me see. Let me see whether I'm able to. This debit, and I hope now you're seeing me, will be written here. Let me put this into perspective. We will put that debit there. Then the account title is there. Account title is there at the center, right? And then this other side, we have what we call a what? A credit. I hope those people who are complaining are now able to see this. On that side, we have a what? Credit. Account title here, probably we talk about, no, but you should first capture that. Title. Title. And then a credit on that side. Two people still joining class at this time. Sarah, Ado. So this is it. We have what we call account title here, which may be in form of a specific asset, for example, motor vehicle account, right? And then we have this side is debit and the other side is credit. Or you can write them the way they have written them here. It is still one and the same thing. That's the way a T account looks. And it is called T because this is a letter T, right? This is why it is named a letter T, a T account. Because that one, what I have highlighted there is letter T. That one is letter T. Therefore, we call it a T account. I'll be giving you how this description should look like, right? And basically, let me try and put it here. It should be something like, let's say, motor vehicle account, right? And then we have, let's see, whether we can insert some of these things here. Right? And then we'll have this line there. And you people stop messing me up. You expect me to continue sharing the screen if you're doing what you're doing. You're telling me to share the screen. Let me see. Tears. So we continue. We should continue. We should continue. Here's my chart. Everyone in the meeting, so we continue. Good. We have talked about the T account. We have talked about the T account. However, it is good for us to note when it comes to credit debit entries. When it comes to credit debit entries, it is important for you to note that an account is debited when amount is entered on the left side. So when we enter an amount on the left side, we say that we have debited the account. And we say that we have credited the account when an amount is entered on the right side. I hope that is clear. Let me again put it here. That I'll mute you from this side so that you don't interfere with the chatting as we are learning. Yeah. Let me mute you from this side. We have seen that an account is debited when an amount is entered in the left side and credited when an amount is entered on the right side. I hope that is clear. Now, at the end of the year, the difference between these two sides, the difference between those two sides will be called balance or account balance. The difference between the credit side and the debit side will be called what? It will be called account balance. It will be called account balance. Now, if the credit side exceed the debit side, if the credit side exceed the debit side, then the account has what we call a credit balance. It has what we call a credit balance. And if the debit exceed the credit, if the debit side exceed the credit side, then the account has what we call a debit balance. It will have what we call a debit balance. Let me also put this there. It's important for you to be able to follow. Put that one there. I hope you've seen that. That you say that if the credit side exceeds the debit side, then the amount of the balance will be called the credit balance. And if the debit side exceeds the credit side, then the amount therein will be called a what? Will be called a debit balance. It will be called a debit balance. Now, we have what we call debit and credit rules. We look at debit and credit rules, some of the rules that are supposed to guide us, some of the rules that are supposed to guide us, some of the rules that are supposed to guide us when we are posting or when we are posting transactions, when we are posting transactions. Now, each transaction must affect at least two accounts. Each transaction must affect at least two accounts. We saw this when we were talking about the principles of account and talked about duality, right? And therefore, this type of accounting is called double entry system of accounting. It is called double entry system of accounting. Me again post this there. Those people who are each transaction affects at least two accounts, and that system is called double entry system of accounting. It's called double entry system of accounting. Now, when accounts are used in accounting process, each transaction must be analyzed, of course, to determine which accounts are affected. Because you cannot just post anything for the sake of posting. No, for example, when I tell you I went and bought a farm machinery, you cannot just conclude that that is a purchase account or it is money account. No, there are rules that are followed. And we are saying that every transaction must be analyzed to determine which accounts are affected and which account should be increased or decreased, right? So that we are able to determine which account will debit or which account will be credited. Now, whether a debit or a credit is a decrease or increase on the account balance will depend on whether an account is an asset, liability, or owner's equity. Whether a debit or credit is a decrease or increase in the account will depend on whether an account is a what? Is an asset, liability, or owner's equity. And it is good for us to look at this soberly, because I know there are people who always become confused later. Because now we have talked about accounts, and we have said there is a debit side and there is a credit side. How do you know which side you are supposed to debit and which side you are supposed to credit? How do you know that I'm going to debit this, I'm going to credit that? And I've said that you must be able to analyze every account, every transaction that has been given to you for you to be able to know whether it should be debited or credited. But further, I have said that whether it is a debit or a credit, and whether that debit or credit will decrease or increase the account balance will depend on whether that account is an asset, a liability, or the owner's equity. Now, these are simple rules that you can use. One, if you are dealing with an asset account, this side is the debit, right? It's a DR, and the other side is a what? Credit, right? One side is the debit, the other one is the credit. Any increase must be written on this side of debit, right? And any decrease in that asset must be written on this other side of credit. I hope that is clear. If it is an asset, you debit to increase and you credit to decrease. People are still coming to class at this time. Good. If it is a liability, and probably before I do away with the debit, with the asset, maybe we can get examples of assets from you. Can you people give me examples of assets? Yeah, we have motor vehicle, right? We have a house, we have land, we have what else? Furniture, television, a laptop, a table. Those are things that represent ownership, things that you own, right? These are things that represent what? That represent ownership, Good, we go to the liability. For the liability, We have a debit there and a credit on the other side, right? And therefore, this side, any increase must be recorded as a credit. Any increase must be recorded as a credit, and any decrease must be recorded on this other side as a debit. So it is the opposite of the asset account. Number 3, it is the owner's equity. It is the owner's equity, or you can also call it capital, right? And for capital, it is treated the same way as liability. It is treated the same way as liability. It is treated the same way as liability. Then you also have expense account, expenses. You know, the things that you spend money on, right? Be it rent, for example, be it salaries, right? Wages, right? Electricity. In such accounts, you debit there to increase. You want to increase, you do what? You debit it. If you want to decrease it, you credit. You credit it on this other side. I hope that is clear. Any question? You can ask a question. You can ask a question. I've opened up the chat. Maybe two questions of what we've covered. 2 questions very fast. 2 questions very fast. 2 questions very fast. Two questions very fast, very fast. Giving you 2 minutes or 1 minute. 1 minute. Good. Maybe I can review what you've asked. I hope there are not many questions. These are so many. I may not be able to go through each and every one of them. About revenue. Revenue, what have we said? You treat revenue like liability, where you credit the increase and debit the decrease. Credit the increase and debit the decrease. That is okay. What of revenue? What of revenue? I think that was the question that excuse me, teacher, should we write on both sides? What both sides? Oh my, some of these questions are too difficult. What have we said on the expense account? What have we said on the expense? Someone can answer that. How is theft? Uh, how is theft recorded? How do we record that? Examples of liability: a bank loan, money that does not belong to you. Liability are monies that belongs to the outsiders. How do I put this? Let me put this. Let me put this into perspective as we proceed. Because accounting, if you don't get it at this point, I told you, you might never get it again. So we have what we call accounting equation, which we had seen sometimes earlier. Accounting equation. An accounting equation simply tells us that assets should be equal to what? Liability plus capital, right? That is what it says. That our accounting equation tells us that liabilities should always be equal to what? Why are these things following me? That we have assets here. We have accounting equation. Sorry. Accounting equation. That's the way it is. I hope you are able to see this. That asset is equals to liability plus capital. Liabilities are debts, contribution of outsiders to our own business, right? Capital is our own contribution to the business. Capital is our own contribution to the business. And therefore, the assets that we have can either come from outside the business or they can come from our own contribution. They can either come from outside the business in terms of liabilities, or they can come from what? Our own contribution. That's why we say assets, that is the items that we own, is equals to liability plus capital. I hope that is clear. Who are writing all manner? How will I even see the question that you asked? Or should I just continue? I've mentioned about revenue. Should you write on both sides? What side do you want to write on? Pardon, on the expense. I've already said that. How is theft recorded? Oh, we know. Is that a question? Examples of liability. I've given a bank loan, for example, money that you've borrowed from a bank or from a friend, and you've invested it in your business. That is a liability. That is well answered. Yes, yes, yes. You can treat revenue like the liabilities in terms of increase and decrease. What is to debit and what is to credit as defined? We have said I've given you a T account where we said that one side is a debit, the other side is a credit. To debit, it just means writing amount on that side of debit, the DR, and to credit is writing the amount on the other side of credit, that is the CR. So we treat the expenses, debit and liability the same as owner's equity. A pardon on the expense, I've already said that. When the increase or decrease in the respective account, then they will be posted on whichever side of the ledger. Now that's what I've just explained. Who is this Gideon? You cannot just post them in whichever side you like. That's why we have said it will depend with whether it is an asset or whether it is a liability or whether it is capital, owner's funds. And I've explained that for all these things, if it is an asset, it will be treated differently. Assets and expenses account are the same. Excuse me a bit. Yes, so we can proceed. Yes, explain the expense account. Oh my. Expense account I've already explained. You know, if you are doing a business and you spend any amount of money, whether you are paying rent, whether you are paying electricity for your store, right? All those are expenses. All those are expenses, Wycliffe. Why is an increase in expense debited? Those are the rules in accounting. Just take them simply to be the rules. Take them simply to be the rules. Yeah. At this point, just take them simply to be the rules. Don't try to understand them so much. I think that should help. My friend, Donald, those are the rules. We know as in two accounts debit, as in which two accounts does it affect? What now? I'm not able to get you. Please pardon on expense. We've already talked about that. I have no question, sir. Thank you. Hello, sir. I can't hear a thing. For trial balance, which is expenses located. My friend, don't put the cart before the horse. We will get there. We'll get to know between return inward and return outward, which is an asset and which is a liability. We'll get there. We'll get there. You're jumping before the gun. Is your body an example of an asset? Ah, how do you would you attach any value to your body? No, you cannot. Therefore, it's not an asset in accounting. It's not. It is not an asset in accounting. And the drawings, we'll get. You even know about drawings? What do you know, Robert? You're going ahead of us, my friend. Eh? Robert, slowly, my friend. Hmm? How do we classify cash and bank account in terms of credit and debit? These are assets. These are assets. So check the rules that we follow when you are debiting or crediting assets. Narrate, share the question. Maybe we can Uh-huh. Excuse a bit. I can't see the chat that people asked questions. Eh? Like of you, write increase, should write decrease on the other side. Mhm. Then theft is not recorded. Expense treated as an asset. Uh, expense account, debit increase. Uh, expense increase is debited, and on expenses debit the increase and credit. There are no more questions. When expense increase debit, we'll come to know why that happens. Some are challenging. They are not challenging. They are good. They are good. So we can proceed. Well, we can proceed. We can proceed. We can proceed now. Good. I think I've answered most of your questions. I have talked about also the accounting equation, right? I have talked about the accounting equation. I have talked about the accounting equation. What is remaining? You allow me, kindly, you allow me, this bed Solomon, calm down. Calm down. We'll get there. We'll get there. We'll get there. For now, I'm saying you allow me that as far as the ledgers are concerned, we'll do them using the T account. As far as the ledgers are concerned, we'll do them using the T account. And that means I may not introduce the other account, right? Or the other way, whichever is easier. But let me see. Let me see. I can maybe highlight this for those people who are curious and who must be able to follow. Let me highlight this for you. Now, we had said that we have two types of ledger accounts. One, T account, and two, running balance form of account or of ledgers, right? So far, we have tackled the T account, right? And therefore, the other type of balance form is what we are calling the running balance form of ledger account. And this one has what we call a date column. It has an explanation forum. It has a place where you can write reference. And normally this is not even in practice nowadays. And then it has a debit and a credit column. And then it has what we call a balance. It has a balance. It has a balance column. In reality, it looks like this. It looks like this. This is still another method of recording, right? Where now here you record the account title, let's say motor vehicle or a landed building or furniture, right? And then here you write date, right? Start with the date. Then explanation is what has happened. You know, if you've purchased a motor vehicle, that's what you write there. If you purchased a motor vehicle, you write it there. And then once you decide whether it is a debit, then that's when you put the amount. And then eventually here is the running balance or the balance of that account. So this ledger is self-balancing. At the end of it, you should be able to get what? To get the balances there. Thank you. So we continue. Is expensive an asset? What do you mean expensive? What is expensive? Expensive ni nini? Yes, Peter Murigi. Almost similar. We think that is expensive. Is expensive an asset? What are we talking about? Oh my. I may not be able to help. I may not be able to help some of you. An expense. An expense is not an asset. How can an expense be an asset? And these are things that you buy for the sake of business. You know, you're cooking chapatis, you go and buy a pan for that business. How can it be an ini? It's an expense. You've spent money. Though the pan is an asset, but you have spent money on it. So expense is the amount that you have spent. So expense is not an asset. It is not an asset. So we proceed. We proceed. Having said that, side increases recorded. We can probably see some of the accounts that we record so much. Before we talk about generalizing, let me share this so that we know some of the ledgers accounts that are commonly used. Some of the ledger accounts that are commonly used. Some of the ledger accounts that are commonly used. Some of the ledger accounts that are commonly used. So we have what we call balance sheet account. We'll have what we call assets and liabilities. Among the assets, we have cash, we have prepaid expenses, we have equipment. These are examples of assets. We have notes receivables, we have land, we have inventory or stock, we have account receivables, we have buildings, and we have stock. These are some of the most common. So when you know this, that it is an asset, then you should know how to treat it. Can people stop bad behaviors? Can you stop writing on my presentation or I'll pull it out? May I just pull it out? Good. Examples of liabilities, on the other hand, are what we call, we can have notes payable, long-term loans, we can have account payables, we can have what we call unearned revenues, or we can have other short-term liabilities. Then owner's equity, or what we call capital. Owner's equity, or what we call capital. This records the owner's interest in the firm. Of course, there are many things that will affect it, and one is the investment, the asset owned by the owner. When he withdraws an asset from the business for personal use, his capital or owner's equity will be affected. When he earns a revenue, that again will be affected. Now, we will come to see that in effect later. In income statement or profit and loss account, this is the same as profit and loss account. Profit and loss account, we may have revenues in terms of sales, right? And you may have expenses account, For example, the salaries that we've paid, the rent that we have paid, the electricity that you have paid, the depreciation that has accrued, right? These are just some of the examples of accounts that are so very common, that are very, very common in business. Very, very common in business. High school format is acceptable, but I will give forward a way forward on that. I'll give a way forward on that. Do not want to deal with journals first before we do ledgers, right? Journal can come in later. Journals can come in later. For now, just to concentrate on ledger accounts. Concentrate on ledger accounts. Let me see. I think now we should be good to tackle an example, right? We should be good to tackle an example. This is the right time for us to do what? To draw up accounts, for us to know which account will be affected by what. I want to give some examples here, which are very, very, very important. Should I share this? Now, I want us to try and formulate accounts that will be affected here. Let us have accounts that will be affected here. Let us formulate accounts that will be affected here. Good. I hope we can all see what I have here. I hope we can all see what I have here. And simply put, this is a type of question that you are likely to get. You are to enter the following transactions, completing the double entry books in the books of so-and-so in the month of May 2002. Started the business with 2,000 cash in the bank. Started the business with 2,000 cash in the bank. Now, I want you to look at those statements very carefully. We said that for every transactions, 2 accounts will be affected. That is what is called double entry. That every transaction like this one should affect 2 different accounts. It should affect 2 different accounts. Now, for example, that transaction there, where we say that this person started a business. This person started a business with 2,000 pounds in the bank. What accounts do you think will be affected by that transaction? I would really want to see. Let me see. Have I given? I have not given you powers to. Doing my presentation. What accounts will be affected by that transaction that happened on May 1st? May 1st. If you look at it carefully, you will notice that it is a business this person is starting, right? They have started it with 2,000, and therefore in the bank, there is 2,000, right? So one of the accounts that will be affected is the bank account. And therefore, the other account that will be affected is what we call capital. It is the capital, again, that will be affected by 2,000. Which account do we debit and which one do we credit? Credit. Can we first copy this? Good people, I'm giving you 5 minutes. Kindly copy this information because I'm going to pull it off so that we can concentrate. Copy that information there. Copy that information, whether it is a photo you take or it is a screenshot and print it later, whether it is just writing it down, but copy that information. I'm giving you 2 minutes. 2 minutes, 2 minutes only. Two minutes. I want to hope that we've written that now. I want to hope that we've written that now. Good. Now I want you to look at those transactions. The first transaction, we have already identified that when you start a business, that transaction will affect two accounts. One is the bank, and the other one is capital. And therefore, allow me to share what screen. Let's see. Allow me to share this screen so that we can draw those accounts here, so that you know what we mean by them. And therefore, if I was to draw those accounts, let me see. I'm going to get some. I would draw two accounts. Remember, these are T accounts. And I'll do another account here. Draw that account there. This account, I will call it what? Bank account, right? Bank account. This other account, I will call it what? Capital, because we have said two accounts must be affected by every transaction. So this one is capital account, and the other one is bank account. One is capital, the other one is bank. What did we say? If you go back to where you said, if it is an asset, an increase will be done what? An increase in asset will be debited. And therefore, here, I will record that transaction here and say, for example, it was on 1st of May, right? And on 1st of May, what did I do? I started a business with some capital, right? And that capital was of how much? We try to make that. And that capital was how much? 2,000, if I'm not wrong, right? We said that an increase in an asset should be debited, and a bank account is an asset. And then we said an increase in capital should be, an increase in owner's equity should be, it should be credited. So on the same date, right? I have some capital, and that capital is in form of bank, right? And therefore there, I will have to write 2,000. Therefore, that one single transaction, has affected two accounts. It has affected bank account and it has affected. Now I will have completed the posting of that first transaction that happened in 1st May. Can you see that? I will have completed that transaction. Then number 2, there is this transaction that on 2nd May, what happened? Purchased goods worth 175 on credit from Mr. Brooks. We purchased goods. So what accounts will be affected here? I want to hear from the gurus. What accounts will be affected? What accounts will be affected by that debit, by that transaction? What account will be affected? Good people, good people. What account? Yes, yes, yes. Who is this raising their hand? I can't see you. Ah, yes. Dina. What account? Dina? Is it Dina or Dina? What account? Dina? Dina?
Bank account.
Bank account?
Bank account.
Yes. Thomas. What account, Thomas? Thomas, what account?
Purchases account and Mr. Luke's account.
Ah, Thomas. That is nice. That is nice of you. That is nice of you, sir. That is nice of you. Yes, indeed. Indeed, if you look at that transaction, if you look at this transaction, we have purchased some goods, and therefore purchases account would be affected. And then those goods have not been purchased in cash or in bank. We have not paid any money. And therefore we still owe Mr. Rooks some money. And therefore we'll open an account for him, right? Because we have his debt. And therefore, in that case, I will come and continue and open. And those people who are spoiling my work here, not spoil my work. Kindly. I will come again here. Let me see what has happened here. Until clear. That. We'll come and draw another account there, right? I used the wrong one. Draw another account here. I'm drawing another account there. And therefore, because I don't have those accounts here, I will draw another account here and call it what? Purchases account. Account. And another account that will be affected here will be what we are calling what? What is the name of this guy? Brooks account. You see that? Now, who can tell us whether we debit or we credit And which account do we credit and which do we debit? Which account do we credit and which one do we debit? This is Onyango. Yes, Onyango?
Yes,
Yes, Onyango?
we debit purchases account
Yes.
and credit Mr. Rock's account.
Thank you, sir. Thank you, sir.
Yeah.
So here we can simply have a simple narration, right? This time I don't want to mess us up with narrations. So I'll just put a date 0205, right? And that amount that is in purchases has come from Mr. Rooks, and it is amount 175, right? It is a debit. Then on the other side, I come and do what? Go to the Mr. Rooks because we owe him some money. And say, for example, on that same date, I have done what? I have done some purchases, right? And that purchases is worth 125. So in short, where there is a credit, there must be a debit. And the debit and the credit must always balance. I hope we are getting that.
Yes.
Number 3, or date 3, bought furniture and fittings for 150, paying by check. Bought furniture and fittings 150, paying by check. Who will assist us? Bruce Kiprono. Bruce Kiprono. Mr. Bruce. Bruce is not responding.
Hello.
Yes.
Hello.
Yes, Bruce.
We have furniture and fittings account
And
the bank account.
And the bank account, because he has paid by
Check.
And because I do not have those accounts, what do I do? What do I do?
Create.
I create them, right? And therefore, I'll come here and draw another account because I don't have them. And draw these accounts.
Yes.
So we have which account and which account? Furnitures and fittings.
Account.
Furnitures and fittings. Accounting is not for lazy people. Accounting is not for, it is not for lazy people. Then the other account is what?
Bank account.
Bank account. Which account do we debit and which one do we credit? Do we have a bank account? Do we have a bank account? Yes?
Yes.
Do we need to create another one?
No.
Good
No.
people, yes. You don't have, because you already have it, the one that we had already created, and therefore we don't need to create an account that is already there. So which account do we debit, which one do we credit? Yes? Furniture account is an asset account, right?
Yes.
Therefore, any increase in asset should be debited. You see that?
Yes.
And therefore, this has been paid through the bank. And what was the amount? 150.
Yes.
Then the amount came from the bank, right?
Yeah.
I will come there and say on 3rd May, we bought furnitures and fittings, right? We bought furnitures and fittings at 150. Are we able to see the account? How we are coming up with the account?
Yes.
Yes.
We continue. Number 5, date 5. Date 5, we sold goods on cash for 275. Who is Chekuki Paul? Chekuki Paul? Chekuki Paul? Chekuki Paul?
Sales account.
Yes?
Hello.
Yes.
Sales account.
Sales account?
Yeah.
Yes? What else?
Sales account.
Yeah? 2 accounts must be affected.
And only. Yeah.
You only know one.
Yeah.
Thank you. Thank you. Sahara. Sahara do. Sahara do. Where are all these people? They are not communicating. Bogala. Bogala. Richo Irimo. Richo. Richo Irimo. Talk to us.
For 2 accounts for goods and cash.
For goods and cash.
Cash.
Cash is one, I agree. But what about these goods that we have sold?
Sales.
Sales, because we do not have an account called goods. Right?
Sales.
Good. Thank you.
Sales.
Thank you. Thank you. Thank you. So we have sales account and
cash.
And cash. Thank you. Thank you so much. So we come and again, because we don't have those accounts here, we will create them, right? We come and create them. We come and create them. We already have another one here. So here we have sales account, right? And then we have cash. We have cash account. So which account do we credit and which one do we debit? Yes? Which account do we debit? Which one do we credit? Adhiambo or Mireti Tracy. You can talk to us. Mireti, talk to us. Mireti B. Tracy. Mireti is just smiling at us. Who's smiling? Who is this? Oma Lorraine. Oma? Oma? Some of you are disappearing. Thomas Mokua? Thomas? Thomas Mokua?
Hello.
Yes, Thomas. I'm hearing you. Talk to us. Which one do we debit? Which one do we credit?
Sales you credit and then cash you debit.
Yes, because cash has increased, right? Cash has increased, and the cash is our what? Is an asset. And therefore, we record an increase in sales there. What was the amount? 275. 275. Then sales, we did cash sales. Sales of 275. I want to hope that these things are making sense. I want to hope that these things are making sense. Date 6, bought goods on credit from Peace Court. Bought goods on credit from Peace Court. Who will answer this? S45. Who is S45? S45. Doesn't want to talk to us. We can get Vincent, keep quiet. Keep quiet.
Hello.
Yes, Onyango. No, who
Hello.
is this? Vincent.
Yes, yes, sir.
Yes, yes. Which account will be affected?
We have purchase account
Purchases account,
and we have Peace Court account.
and we have Peace Court account. Now, what I want us to do, we have like 40 minutes remaining, right? 40 minutes remaining. I want you to do this. For example, on 6th, I want you to do this so that on 6/05, there was a transaction there. I want you to identify, and I might be tempted to mark this, that becomes a part of the assignment. I want you to be able to identify 2 accounts that will be affected, right? I want you to identify 2 accounts that will be affected here, so that if it is the one, who is it I was talking to? You have told us that on 6, bought goods on credit, so we have purchases and we have Peace Court. So you identify for every transaction, identify for me so that we have here purchases account, and you've told me the other one is Peace Court. Peace Court account, right? Those are the 2 accounts that will be affected. Then you tell me which account will be credited and which one will be debited. In this case, we debit, right? And for Scott, we credit. We debit there. And with what amount? What was the amount? 114. Debit with 114. Here, credit with 114. I want you to take this seriously. Identify for me transactions from date 10th to date 31. Tell me what accounts will be affected by those transactions. Tell me what accounts will be affected by those transactions. And I want that to happen in the forum, in the normal forum. Let me put it there in the normal forum. I want us to engage there so that you identify 2 accounts that will be affected in each and every case, right? Identify 2 accounts that will be affected in each and every case there. And I think that should be, after that, we might be closing off because you only have a few minutes remaining, right? So let me put topic 3 forum. Topic 3 forum. Topic 3 forum. Counting cycle. If accounts to be affected. You already have the illustration, right? I want to hope you already have that illustration. But before that, I see. Let me see this. Let me see. Minute, do not log out first. Admit. Minute. Something here. So I would urge us to just exit from the Zoom, right? We go to the normal group forum on the ZDS, right? And then from there, we participate in that question that that is there. We participate in the question that is there. Thank you.